Silver plummeted 31% to end the week under $80, enduring its largest single-day drop ever documented. Not the greatest in 10 years, not the greatest in half a century, the absolute largest ever recorded. $7 trillion vanished from precious metals in just one day. Silver dropped 31%, erasing about $2 trillion. Gold fell 11%, wiping away around $5 trillion. Platinum declined 20%. Palladium dropped 16%. And here's what I'm going to reveal. This wasn't random. This wasn't natural market fear. This was orchestrated. And I have the evidence. If you examine the recent COMEX report closely, JPMorgan exited its silver shorts right at the lowest point of the price plunge. And from that moment, things began to rebound. This isn't chance. This isn't wild speculation. This is the evidence that the entire Friday collapse was intentional. Checking the stats, about 3/4 of you are viewing but not subscribed. If this is breaking through the nonsense and aiding you in understanding the market better, please subscribe. It assists me and my team in seeing what connects and in better supporting this group. If it's not for you, that's fine. I'm not after meaningless numbers. I'm focused on those seeking straightforward facts, not the refined, deceptive, and frequently disconnected material from many traditional outlets. Now, let me explain precisely what occurred. The COMEX report from January 30th, 2026 indicates JPMorgan Securities liquidated 633 silver contracts. The timing was spot on at the nadir. The price fell from over 100 to the low 70s, and right at the very bottom, JPMorgan shut down 633 short positions. Then what followed? The price began to rise again. From that point, the upturn started. This isn't guesswork. This is official COMEX information. And here's another key indicator. 2,514 silver February 26 futures contracts received delivery notices. Physical interest remains strong, but on January 30, COMEX Silver saw about 368,561 futures contracts and 28,152 options contracts traded. Each COMEX Silver contract represents 5,000 ounces. That's roughly 396,700 contracts altogether. That amounts to about 1.98 billion ounces of silver exchanged in one session. Let me repeat that. 1.98 billion ounces, nearly 2 billion. In a globe where yearly mine output is 800 to 850 million ounces, they moved more than double the whole world's annual mine supply in a day. This wasn't genuine pricing. This was handling liquidity through imaginary ounces. And the sequence, let's link the pieces. The US government braces for a shutdown. Then the Senate approves a measure to prevent it. The first US bank failure of 2026 happens. Chicago's Metropolitan Capital Bank and Trust turns into the year's initial bank to fail. It was shut by Illinois authorities because of risky practices and low capital. Assets, $261 million. Deposits, $212 million. Impact on FDIC fund, $19.7 million. Polymarket chances of a U.S. bank collapse on January 31st spiked to 99%. Something major is approaching. Liquidity contracts throughout the network, and precisely on cue, paper silver gets hammered. Ideal timing. Completely natural. Purely accidental, huh? No. While sellers halt operations, shipping delays extend to 8 to 16 weeks. Stocks disappear, and real-world premiums separate. The futures market unloads several years of global silver output in mere hours. Futures markets handle anxiety. Physical markets handle truth. And when administrations delay, banks crumble, and confidence fractures, actual metal doesn't reappear in circulation. It vanishes from it. Now here's what you must grasp. Shanghai spot silver stands at $122 right now. COMEX ended at $84. The Shanghai markup is $37, following a 31% plunge, the biggest daily decline ever. And the markup remains $37. Physical silver in China trades 44% over COMEX. The markup didn't shrink. It didn't vanish. It expanded. Now, before we proceed, let me speak to the two types of viewers here currently. First, to the veteran accumulators, and that's the majority here, roughly 70% of this audience. Many of you have been building stacks for years. You have a strategy, and you're committed to it. You get the basics, and your horizon isn't day-to-day or minute by minute. It's over months, years. You allow time to work its magic. You witness a 31% drop and you're not rattled. Actually, you view it as a chance. Whether that involves buying in immediately or waiting for a bit more decline to accumulate extra, for you, the core elements stay the same. In truth, with the Shanghai markup still elevated, you notice the increasing gap between futures and physical sectors. You're calm. You grasp the larger economic view. Even after this fall, you're likely more focused on the fact we're still up 19% on the monthly finish. This fluctuation doesn't unsettle you. But then there are the quick-turn traders, particularly those lacking a strategy who assume markets advance linearly. For you, this has been catastrophic. A 31% daily fall with heavy leverage is a wipeout horror. Some might have profited, but if you were overextended, on the incorrect side, or operating without control, this shift ruined you. Compelled sell-offs ignore your outlook. I've been alerting about this for a while now. Excessive leverage, the dangers of brief-term trading without structure. Review the earlier videos. If you're fresh here, check them out. If you've been following from the beginning, you anticipated this possibility. We had a plan. And for all the newcomers, let me clarify. I don't offer signals, coaching, or programs. The true veterans here understand this. My username is OGJohnAG on both YouTube and Twitter, and if you're not tracking me there, you're losing out on timely updates. We talked about a potential dip to $86 or lower post-Fed chair selection, and it occurred. The genuine long-timers already knew. Be cautious of numerous phony profiles altering content, reusing my insights, and providing false data and narratives. I am not accountable for that. Confirm the username. Follow the authentic one because I don't present a single perspective here. No panic, no avarice. I've never issued a trade call or picked a side. I deliver the impartial facts, and I've always advised you to think independently. Know which group you belong to, the long-haul accumulator or the brief-term operator, and proceed based on that. So, let's dissect what this COMEX report is truly indicating. JPMorgan liquidated 633 silver short contracts precisely at the lowest point, not close to the low, at the low. Then the price bounced back. This is the evidence the plunge was scheduled, managed, and carried out with accuracy. They recognize exactly where the floor is because they're establishing the floor. They flood with enormous paper volume, ignite chain reactions of sell-offs, trigger every stop loss, clear out the vulnerable positions, and then exit their shorts at the nadir. It's an ideal operation, and it's evident in the COMEX figures. Here's the midway disclosure that changes the entire perspective. This wasn't an adjustment. It was an intentional futures massacre. The abrupt decline we've observed, gold off 10%, silver diving 31%, wasn't a standard market shift. It was sparked by huge disposals in the futures markets by big institutions. No additional real ounces of gold or silver emerged from this action. The core drivers remain unchanged. Investor purchases stay robust, particularly in tangible bars and coins. Central banks will keep acquiring gold. Silver availability is still constrained. Mine production increases gradually, while surface inventories deplete. Industrial demand for silver remains intensely strong. Sectors like solar, electronics, electric vehicles, and others continue to draw the metal out of circulation. This establishes a firm support level rapidly, particularly for silver. Producers now possess a steadier foundation to recover from. Mining equities are projected to double in value over the coming 6 to 12 months as stability returns and the upward trend restarts. 1.98 billion ounces of future silver exchanged in one session. Yearly worldwide extraction ranges from 800 to 850 million. They moved more than double the annual output in mere hours. Meanwhile, actual purchasers face delays of 8 to 16 weeks for receipt, while Shanghai markups hover at $37, while COMEX delivery alerts reach 25,014 agreements. The derivatives arena and the tangible arena are entirely separated. And the evidence that this was orchestrated appears in the COMEX filing. JPMorgan exited 633 shorts precisely at the lowest point. And here's another trigger. The initial U.S. bank collapse of 2026. Metropolitan Capital Bank and Trust shut down by Illinois authorities. Polymarket showed 99% probability of a bank collapse on January 31st, and it occurred. Assets totaled $261 million. Not a critically vital institution, but it's the opener. And when the first bank goes under, worries about liquidity grow. Risks with counterparts rise. Confidence weakens. And what follows? Rush to secure assets. But this round, the protective holdings were hit hard initially. Why? Because the opening response is always asset sales. Forced liquidations compel offloading of all, including gold and silver. Yet then arrives the follow-up stage, the awareness that the framework is vulnerable, that institutions are collapsing, that reliability is fracturing. And that's when the protective demand rebounds. That's when tangible markups skyrocket. That's when requests for delivery spike. We're amid the shift from stage 1 to stage 2 at present. Now, let's tackle the pessimistic view, since a 31% plunge, the largest single-day drop ever, is devastating if you were positioned incorrectly. This isn't trivial. If you traded with borrowing, you were wiped out. If you set narrow limits, you were triggered at the harshest rates. If you were overloaded, you're deeply in the red. The chart harm is extreme. And here's another hazard. CME is increasing requirements on COMEX gold and silver contracts, following prices enduring their steepest falls in years. Requirement boosts post-crash. That's piling on more pain. If you maintained futures holdings and endured the drop, now you must add extra funds or be ejected. That generates additional downward force, further closures, greater swings. The debut bank downfall of the year just took place. If additional banks crumble, if funding keeps constricting, if lending situations deteriorate, we might witness more compelled disposals across every category. The starting response to economic strain is always risk aversion. Dispose of all, gather funds. It ignores that gold and silver should serve as refuges. In the earliest phase of turmoil, margin demands and cash requirements compel disposal of fluid holdings first. The derivatives sector can remain illogical longer than many participants can remain viable. We just observed 7 trillion vanished in a day. No assurance it halts now. We could observe more disposals, more closures, more alarm. If you're operating this with leverage, this setting is a shredder. Even if the extended outlook is accurate, the immediate turbulence can destroy you prior to the reversal. But here's why the negative outlook for derivatives doesn't alter the positive outlook for tangible. JPMorgan terminated 633 short agreements at the precise nadir. That's not guesswork, that's COMEX info. They nailed the timing. How? Because they engineered it. 2514 delivery alerts for February. Tangible need persists. 1.98 billion ounces of derivatives moved against 850 million yearly extraction. The derivatives myth is now over double yearly output exchanged in a day. Shanghai markup $37, following the largest daily plunge ever, 44% extra. In typical conditions, markups shrink or vanish during drops. Tangible vendors freak out and oversupply the sector. Markups turn inverse, but not now. Shanghai holds at 44% above COMEX. Tangible acquirers in China are shelling out almost 50% more than derivatives operators in New York after the most severe drop on record. That's not a shattered upward market. That's a manipulated derivatives market forfeiting all trust. Outlets halting operations, receipt periods 8 to 16 weeks, stockpiles evaporating, tangible markups diverging, and the derivatives market unloads the equivalent of over 2 years of worldwide output in hours. This is the finale. This is what transpires when the derivative setup is nearing collapse, and they require one last enormous purge to readjust stances before truth engulfs them. So, where does this position us? 3 main insights and we're done. Number 1. JPMorgan terminated 633 silver short agreements at the precise nadir of the plunge. This is recorded in the COMEX filing dated January 30th, not close to the nadir. At the nadir, then the value bounced back. This isn't chance. This isn't wild speculation. This is evidence the Friday plunge was arranged, scheduled, and carried out with accuracy. They form the nadir, exit their shorts, and gain on both sides. Number 2. 1.98 billion ounces of derivative silver exchanged on January 30th. Yearly worldwide extraction is 800 to 850 million ounces. They moved more than double yearly output in one day, while tangible acquirers wait 8 to 16 weeks, while Shanghai markups hover at $37, 44% above COMEX, while delivery alerts total 2,514 agreements. The derivatives market is sheer invention. The tangible market is yelling shortage. Number 3. Initial U.S. bank collapse of 2026. Metropolitan Capital Bank and Trust shut by Illinois authorities. Polymarket had 99% odds. It transpired. Banks collapsing, funding tightening, reliability splintering. Starting response is risk aversion disposal, but stage 2 is rush to security. We're in the shift. CME boosting requirements post-plunge adds extra strain briefly, but it also verifies the setup is under duress and unstable. The lingering conflict is this. We just witnessed the largest daily silver decline ever, but JPMorgan's COMEX placement confirms it was orchestrated. Does the next surge of disposals arrive? Or does the tangible truth reclaim dominance now that the shorts are exited and the fragile positions are cleared? And with the debut bank collapse of the year verified, how? Many more follow. And when does the rush to security stage start? 7 trillion vanished, largest daily decline ever. Initial bank collapse of the year. 1.98 billion ounces of derivatives unloaded in one day. And JPMorgan terminated 633 shorts at the precise nadir. This is the evidence. This is the irrefutable proof. The Friday plunge was orchestrated. They scheduled it flawlessly. And the tangible market is signaling the derivative setup is running on fumes. Conduct your own research. Grasp the dangers. If you're operating with borrowing, this turbulence is a closure engine. 31% plunges erase overborrowed stances immediately. But if you comprehend what's truly occurring, JPMorgan nailing the nadir flawlessly, derivatives exchanging double yearly output in a day, tangible markups maintaining at 44%, then you realize this plunge is not about basics. It's about urgency. It's about one final purge before the derivative setup fractures. Invest with reason, not excitement.